Welcome to CashOps, where finance meets clarity. Today, we're tackling a hot topic that affects all our wallets: recent announcements from the Federal Reserve. The Fed's decisions have a domino effect on everything from your savings account to the broader economy. So let's dive right in and make sense of these changes together. First things first, understanding the Federal Reserve's role is crucial. They're the guardians of our economic stability, tasked with managing inflation and keeping employment on track. Their tools? Interest rates and monetary policies. When inflation spikes, as it did to an alarming 9% back in mid-2022, the Fed steps in, tweaking policies to cool things down without crashing our economic engines. As of the latest updates, we've seen some shifts. The Fed's been on a roller coaster ride with interest rates, aiming to temper inflation without stifling growth. From a peak, we've watched inflation dip, then dodge back up slightly. It's this game of economic tug-of-war that keeps the markets on their toes. Now let's break down what the Fed chief recently shared. He pointed out that inflation, although lower than last year's peak, still hovers above their comfort zone. The target? A cool 2%. We're not there yet, so the immediate plan is to hold rates steady. What does this mean for you? Essentially, borrowing costs, think mortgages, loans, remain unchanged for now, but keep an eye out. The landscape is fluid, and your strategies should be too. If you're enjoying this breakdown and are keen on staying ahead in the financial game, don't forget to hit that subscribe button. Your support helps us keep these insights coming. Delving deeper, the Fed has hinted at a cautious approach moving forward. The key word here is patience. They're not rushing to hike rates further unless absolutely necessary. This is good news for businesses and consumers alike. It means more stability, less panic in the markets. But here's a critical takeaway. The Fed is also prepared for tougher scenarios. If inflation doesn't settle, or if economic indicators falter, they're ready to pivot. This dual readiness underscores the unpredictable nature of our economy today. What's truly compelling about the Fed's current stance is their commitment to a soft landing. This term might sound a bit jargony, but it's essentially about achieving balance. They aim to bring inflation down to target without triggering a recession. It's a delicate act, one that requires precision and careful monitoring of economic data. Let's explore a scenario to see how this might play out. Imagine inflation begins to inch up again, driven by unforeseen increases in consumer spending or a sudden hike in oil prices. The Fed would have to consider tightening monetary policy more aggressively, potentially leading to higher loan and mortgage rates. For the average consumer, this could mean higher monthly payments, a tighter budget, and possibly delaying major purchases like homes or cars. On the flip side, if the Fed manages to achieve this soft landing, what we'd see is a gradual reduction in inflation rates without a significant uptick in unemployment or a crash in stock prices. This scenario would be ideal for long-term economic stability, allowing consumers and businesses to plan with more confidence. As we analyze these insights, let's not forget the undercurrents that could sway the Fed's hand. Factors like oil prices, geopolitical tensions, and other unforeseen events can prompt quick shifts in policy. It's a reminder that in finance, as in life, flexibility and vigilance are key. Approaching the tail end of our discussion, remember the broader picture. The Fed's policies are about crafting a stable economic environment where employment thrives and inflation is in check. For us as individuals, this means adapting our investment strategies, safeguarding our savings, and staying informed. Inflation has a profound impact on the stock market, and understanding its implications is crucial for investors, particularly looking into 2024. Inflation refers to the rate at which the general level of prices for goods and services is rising, thereby eroding purchasing power. The connection between inflation and the stock market is complex. influenced by investor sentiment, the Federal Reserve's response, and the performance of various sectors. Firstly, inflation often prompts the Federal Reserve to adjust interest rates to manage economic growth and maintain price stability. When inflation rises, the Fed may increase rates to cool off an overheating economy. Higher interest rates typically lead to higher borrowing costs for companies, which can reduce their profits and, by extension, their stock prices. This is particularly impactful for companies reliant on borrowing, like those in real estate and construction. Conversely, sectors such as consumer staples or utilities might be less affected as they deal in necessities that consumers will purchase regardless of price increases. Moreover, inflation influences consumer behavior. As the cost of living increases, consumers may cut back on spending, especially on non-essential goods and services. This reduced demand can lead to lower sales and profits for companies, negatively affecting their stock prices. On the other hand, companies that can pass increased costs onto consumers without reducing demand, typically those with strong brand loyalty or unique product offerings, might fare better during high inflation periods. Looking ahead to 2024, if inflation remains elevated, the stock market could face volatility. Investors will likely be wary, seeking refuge in inflation-resistant sectors or more stable investments like bonds or gold. However, sectors that can navigate the challenges of inflation effectively, perhaps through technological innovation or superior management, could present valuable investment opportunities. Thus, while inflation generally poses challenges to the stock market, its actual impact on various sectors and stocks can vary widely, offering both risks and opportunities to discerning investors in 2024. Before we wrap up, a shout out to those who've just joined us. Consider subscribing if you find our content helpful and enlightening. Your engagement helps us grow and continue providing valuable insights. In conclusion, the Fed's recent narratives are a blend of caution and optimism. As we move forward, staying updated will be crucial. Here at CashOps, we'll continue to decode these economic signals, helping you make informed financial decisions. Don't forget to like this video if you found it informative and subscribe for more updates. Every bit of your support fuels our commitment to bringing you the best content. Thanks for watching, and we'll see you in the next video.